Okay, we're going to go through and analyze and take apart this partnership taxation quiz and see what it's all about. First of all, I'm going to say that I think we should see that many of the questions could go rather quickly without the aid of the textbook, because there was principles drilled in during the classroom that I thought would have made this, I wouldn't say a piece of cake, but the questions that could have been quickly answered. So let's see what we got here. Which of the following exemplifies this entity theory? Partnerships are taxable entities? Well, that's not true. So that's out. Partnerships determine the character of separately stated items? Well, that is true. Partnerships, and that's the entity theory. The entity theory is that the partnership makes the determination. That's the entity theory. That it acts like an entity and makes decisions for tax purposes on its own. Partnerships make the majority of tax elections, and that's true. Same idea. The partnership's doing it. Both partnerships are taxable entities. That's not true, so that's out. Both partnerships determine the character of separately stated items, which is here, above, at the partnership level. That's true. And majority of tax elections, and that's on this one, the tax elections. And that means that E is a correct answer because it encompasses the two up here. So E became the correct answer. Under general circumstances, debt is allocated from the partnership to each partner in the following manner. This we really covered in class, and this should have been no brainer. Perhaps this question here, since we didn't talk in terms of the separately stated items overly much about the fact that it's part of the entity theory, is mentioned in the textbook, and I did mention in class, is you have to think of through when something is true, why is it? Is it the entity theory or is it the aggregate? So if the partnership makes the determination of the separately stated items, that must be an entity theory concept. So it might have taken a little thought there, but look, this one, debt is allocated from the partnership to each partner in the following manner. We crushed this one. Recourse is according to the partner with the ultimate responsibility for paying the debt, and the non-recourse is to the profit-sharing ratio. That means D is the only one that's correct because it has both parts of it, and that just should have been a 30-second question, in my opinion. Okay, now we've got a computational, so this may take a little longer, I admit. Let's see what we got. 1231X4 LLC had a $50,000 loss on its books. Included computation was sales of 40, 15 in the dividends, 22 in cost of goods sold, 50 in charitable, 20 in wages, 13 in rent expense. How much ordinary business expense? Okay, so this is test your separately stated items. Theoretically, the computation of the net income to be passed through to the owners is not separately stated because we don't do every line item. We net it all together, but nevertheless, it's still sort of separately stated from other issues. So we have to see what is its ordinary business income or loss. That would consist of $40,000 in revenue from sales. This is just simple profit and loss statement. Now, from this point on, the dividends don't count. That's not part of the net income or net loss of the operations. $22,000 in cost of goods sold, well, that counts. That's direct expense. And $20,000 employee wages, that counts. The charitable contributions does not, that's separately stated. The $13,000 of rent expense, that counts. And that's all we've got. So let's do the math. 42 from 40 is 2,000 plus 13. Looks like it's going to net to a $15,000 loss. That's one of the choices, is it? And it is, and it's D, and it's the correct answer. Which of the following would not be classified as a separately stated item? So here again, it's the idea, is it going to be netted with the net income from operations, or is it going to be separately stated? And you could have just looked at the K1. In fact, if you had brought a K1 to class, like I had suggested, or used it in the textbook, you would have seen that guaranteed payments has a line item. Section 179 has a line item. Charitable contributions has a line item. There's no line item for units of production depreciation. It's included in line 1, net income, and we're done. So it's not separately stated. Yes, it's netted, but there's no specific line item for it. Let's do another couple before we see what time we're running here. Tim, a real estate investor. Ken, a dealer in securities, and Hardware Inc. retail lumber store have a partnership called HKTLP. All right, that's great. HKT is in the business of building homes, and that's also good. Tim recently purchased his interest, while the other partners purchased their interest several years ago. During the current year, it looks like, X3, HKT reports a $12,000 gain from the sale of stock in a wholesale lumber company it purchased in X1 for investment purposes. Oops. For investment purposes. Which of the following statements best represents how their portion of the gain should be reported to the partner? So it's Tim would get a short-term capital gain. Okay, well, Tim, they said, recently purchased. So recently could be within the last year, meaning that it's less, he's owned it less than 12 months. And if he's owned it less than 12 months, it would be a short-term capital gain. And notice the way the question works. It says which one best represents. So let's see what B is. B says ordinary income. Well, this is not. It's a gain from an investment. The problem tells you that. Gain of the sale of stock for investment purposes. So it's not ordinary income. That's out. Hardware Inc. And what we're doing, the problem's doing, is showing you items on each individual's K1 and asking the question, is this, would it be reported this way? Hardware Inc. long-term capital gain? Well, yes, that seems to be true because we do know that several years ago. Here with Tim, we're sort of left with a question mark. Is it short-term capital gain? We don't know. We don't know for sure. It could be, but here we definitely know. Now we've got D, all of these accurate. No, that's not true because we got one that's definitely wrong. E, none of these. No, that's not true because we got one that's definitely right. And so then the answer is going to have to be, the best answer is C, Hardware Inc. long-term capital gain. Okay, let's move on to number 6. Which requirement must be satisfied in order to specially allocate partnership income or losses to partners? Special allocations must have excellent effect. Well, that's a neat word, but it's economic. In the text and in class, we stressed the word economic effect. So that's not right. At least one partner must agree. Well, no, because you can have a majority vote saying how to special allocate. If that's what the partnership agreement allows, the partnership agreement may require all partners to agree. So that's a partnership agreement question. That's not true. Special allocations must have some agreement with the GAAP accounting book partnerships. Sounds like we spent the whole class and maybe a video on that. So that sounds right. Special allocations must reduce the combined tax liability of all the partners. I don't recall ever mentioning anything like that. It seems to be a fabrication of somebody's imagination that's true, because it's really the accounting for book that it has to. I mean, there's some sort of logic to D that it must reduce the combined tax liability of all partners, but not all partners may have a tax liability. So it just again, it seems like a sort of a ludicrous statement. So, and we do know that this is what we were talking about. We had more than one class looking at book versus tax, that the tax has to have some agreement. Answer C, tax has to have some agreement with the book somewhere along the line. Done. Okay. Frank or Bob, let's do one more. If we can do 2, we'll see if we can do 2. Frank and Bob are equal members in Soxy Sox LLC. When forming, Frank contributed cash and equipment. Frank's adjusted basis and the equipment was $35. Bob contributed cash and land. Bob's adjusted basis and land was $30. On 315.4, Sox sells the land for 60. How much gain related to this transaction will Bob report on his X return? Okay, so we know this. If you just do the book capital, you'll be able to figure it out. The book capital would have shown, we don't need it as a T account, really. It's not a T account. The book capital would have shown for Bob, because that's who we're concerned about, that he contributed cash, and he contributed land worth $50,000, so we were shown the land at 50. So he's at 100. And for the books and records of the partnership, the land comes on at fair market value, $50,000. When we're doing book capital accounting, that's what the land would be at. Now, there's a sale of the land for $60,000. So the gain to the partnership is going to be $10,000. Now we have to do the tax capital account for Bob, which would have shown carryover basis. That's you should know, and the land was 30, so the carryover basis for tax was 30. And you got cash comes on at, so he's got 80. The land sells for 60. Land sells for 60. And that means that the gain to Bob on the land, remember this is the built-in, this had the built-in gain of how much? Well, its fair market value at the time the partnership was formed was 50, so the built-in gain at the date the partnership was signed was 20K. And in order to get the book capital, I'm not going to show you it, but in order to get the book capital to agree with what we have over here, with the sale of the land, which is a $10,000 gain, bringing his, well, it's a $10,000 gain, but he shares half. I'm doing this nice, but I'm not explaining it well. I'll go back and explain it. Let me just draw it out. And then I'll explain it. Okay, so let's go back and do the book, and then we'll do the tax. So everything comes in a fair market value for Bob, giving him that. When there's a gain, the gain at the partnership level is based on how much gain did the partnership have for how long it held the property, based on fair market value. It came in at 50, a fair market value, sold for 60 as a $10,000 gain. I put 5 because this is a 50-50 partnership. See? So it brings Bob up to 105. And so the gain that's allocated on an economic sense to Bob is $5,000. That's the book. Let's look at the tax. The tax, Bob came in at 30 on the land. This is the land here. Carryover basis. But the fair market value at the date that it was formed, the partnership, it was worth 50, which is the built-in gain of 20. So when the gain is recognized for tax, remember the property is going to sell for 60. Here, basis is 30. That's a $30,000 gain. $30,000 gain. Now we know that for book capital, we already saw that $5,000 of the gain is going to go to Bob because it's going to follow the books. So $5,000 goes there. And then the other 5 goes to the other partner. So that's 5 over here. Means the only amount of gain left to distribute is 20, because 30 minus the 5 that goes to Bob and his other partner, That takes away 10. There's 20 left. That all goes to Bob, which agrees with the built-in gain that we found up in this calculation here. And thus, A and B are the gains allocated to Bob, 25K, and there indeed is an answer for that one here at C. We're done. All right, a little complicated, takes a little while. You've got to walk through the steps. Might have to see how the book capital works to the tax capital. And to prove it out, if you needed to, you would have found that by allocating the gain this way, Bob's capital account would have agreed with this number here. Let's prove it. I have to go down here. Okay, so let's prove it. So the capital account we're trying to prove to is here. So again, Bob's tax capital account would have been like this. Carryover basis of 30 plus the cash, he's up at 80. When we allocate the gain, we're going to allocate 25 to him based on what we did as an analysis up there. And bingo, his capital account is 105, in agreement with the books here. And what you could have done, you could have worked the other way. You could say, well, I know that after the sale of the land, the capital accounts of the tax versus the book should agree. So you could plug this in and work backwards, and then have found out that the gain allocation needed to be 25 to work. Because remember, gain increases the basis. All right, we're going to hold here. That's a lot of time. We're going to have to come back, and we'll start with number, what number are we starting with? Well, whatever it is. Looks like number 9. Okay, or 8, number, whatever. Stopping here, we'll come back.